Worried about how a painful market correction could impact your wealth? In this video, we walk through the most common hedging techniques you can use to protect your portfolio from downside risk. Welcome to Wealthion. I'm Adam Taggart, founder of Wealthion, and today we're going to walk through the fundamentals for how to hedge your portfolio against the risk of a coming correction in the markets. Now, I recently polled the Wealthion audience about what topics you all would like to see us cover next on this channel, and learning how to hedge was a clear number one. Well, your wish is our command. So let's get started. But as we do, don't worry about taking notes here. Everything we're about to talk about is nicely summarized in a free report you can download at the end of this video. And joining me today to help explain the most common hedging practices are John Llodra and Mike Preston, the lead partners of New Harbor Financial, the financial advisory firm officially endorsed by Wealthion. They have decades of experience putting the techniques we discuss here into practice to protect the thousands of accounts they manage from downside market risk. John and Mike, many thanks for joining me today. Are you guys ready to jump right in?
We're ready. We're ready. Let's get started. Thanks, Adam.
Happy to be with you, Adam. This is something that's near and dear to our heart. We'd love to educate, and we love to be practitioners of what we do here.
All right, great. Well, guys, as we get started, let's just start at the top. Why hedge? What are the benefits of hedging?
Hey, the reason you hedge is to minimize losses, and the key word is to minimize or reduce. You can't eliminate. You cannot eliminate losses or risk at all. I mean, all hedges are designed to defray or to make the sting a little less severe. There's always some kind of deductible involved. And usually that deductible is in the form of the cost of the insurance. And any distance from the present market price to the price in which the insurance kicks in. So everything we're going to be talking about here is not a perfect solution, but it's meant to keep you in the game, to make the ride more comfortable, to make the path less severe. We're living through a time here that feels like there's no risk. We can tell you that risk is higher than ever. At some point, we'll learn that. And a lot of people will learn that the hard way. These hedges are meant to make that trip less painful.
All right, John, I'll let you comment here in just a second, but is it fair to say that hedging is sort of like buying insurance, where you are paying a smaller fee to protect against big downside risk?
Yeah, that's a very fine analogy, Adam. And like Mike said, there is no free lunch in anything in life, and certainly not in investing. And hedging, by definition, comes with some costs, if you will, either real costs in terms of out-of-pocket outlay for that quote-unquote insurance, or lost opportunity. There, as we'll talk about later on, there are ways to hedge by foregoing some opportunity to the extreme upside. And it's about hedging to us is about a broader discussion about discipline, about buy and sell discipline. When we envision an entry of a security or investment for a client, we always do so with a mindset or an action plan of a kind of an upside target action point, if you will, but also a downside target. And those triggers in our kind of game plan, if you will, invoke in our minds and in our action a game plan for either locking in profits, protecting profits, tightening up, the bandwidth of the volatility that one is willing to accept. And I guess we'd be remiss if we didn't bring this practical to folks in their lives. I mean, if we were talking about a perpetual endowment that was around for 300 or 500 years, if you can even imagine that time frame in these days, but we're talking about our clients are real people, real lives, and most of them don't get a do-over with the financial assets that they've amassed. And sometimes the most sinful thing to do is to mess up a good situation. Someone that's got a good solid financial footing, they don't need to, nor should they be taking extreme risk shoot for the moon when they, their biggest risk is unwittingly suffering a big decline that could wipe out good footing. And then just the final comment I'll say, and I think we've already touched upon this. Sometimes the best form of insurance is to not drive the car. We like to use the analogy here in New England when we have a big blizzard. Sometimes the risk is sufficiently high that it just makes sense to keep the car in the garage. It doesn't matter how good a gold-plated insurance policy you have. The best risk-prudent strategy is to keep the car in the garage. And the analogy here in investing, of course, is to scale back. Sometimes just selling an investment outright and locking in those profits or the current price is the best form of prudency that one can exercise.
All right, guys. Well, great context for starting here. And really, I think the reason why there is so much interest right now in a video like this on hedging is largely for two reasons. One, John, as you just said, I think the majority of people watching this video are probably over 40. Some of them maybe even a couple decades older than that. And to your point, they have worked hard to amass whatever wealth they have, but they don't want to have to do a do-over. They don't have the time left in their life. So they don't want to be taking excessive risk with the assets they currently have. They really want to be, I think they're prioritizing safety and capital preservation at this stage in their life than perhaps somebody who might be in their 20s, for example. Secondly, if these folks are regular watchers of this channel, they've seen us talk many, many times over the past months about how extreme today's market valuations are. And so if somebody is holding on to long positions in the market, I think a lot of people watching this video are kind of skittish. They're concerned that things have been so good for so long in terms of market returns that there could be a pretty painful reversion to the mean, and they don't want to become roadkill in that process if prices violently and suddenly correct. And so they're looking for ways to preserve their capital in that type of situation, and that's what hedging is really perfect for. So let's get into the actual specific practices, the most common hedging practices out there. And I do want to let folks know that we're going to walk through sort of a spectrum of complexity. We're going to start with the most simple, and we'll get to the more esoteric near the end. But I really want to underscore that really anybody can hedge, even if it's just using the most basic hedging techniques out there. And John just talked about one of them more or less, which is just not playing the game. So as we kick off here, let's just start with the most simple, guys. And John, I'll go back to you since you mentioned it, but cash is a hedge, correct?
It certainly is. It's I guess maybe a definition of hedging. Hedging by definition is something that mitigates or offsets the potential loss if not for the hedging, the absence of the hedging. So, doing something where there is no corresponding opportunity or possibility of loss is by definition speculation, right? So imagine a 100% stock market portfolio. The act of selling down some of that stock market portfolio down to 75% or 50% or 30%, whatever the number is, by definition mitigates the volatility, potential volatility, as compared to the alternative, holding a 100% invested stock market portfolio. So yeah, the cash becomes a offset to an otherwise potentially volatile portfolio. And of course, when we're talking about volatility, we're talking about both upside and downside. But in the environment we're in right now, as we record this video at the end of September of 2021, we certainly assign a skew to the risk to the downside, not necessarily over the next week or next month, but in the kind of life cycle or cycle horizon that most investors think of, 5, 10, 15 years, that kind of thing. So selling down a stock market portfolio to some degree of cash, a large or a lot, is by definition a hedge as compared to a fully invested one. And the reason that cash is a hedge is self-evident. Cash is not subject to market volatility. Certainly in this current environment, it's not yielding a lot, but again, we're focusing on preservation here, not return on capital, but return of capital. And that cash has an additional feature in that it provides what we call option value. It provides the option or the ability to convert that cash at some more opportunistic time to back to stocks or some other investment that then have more compelling risk reward dynamics than at present.
All right, well said, John. And I guess the only thing I'll add about cash is, when you hedge, as I said earlier, you're paying a small fee to protect against a large potential loss. The fee you're spending with cash is basically the opportunity cost. So should the market just continue going up and up and up and you're sitting in cash, you're missing out on that opportunity. I know a lot of people have been sitting on cash for the past couple of years, have felt like they've taken on a pretty big opportunity cost. But the future is never known for certain, and you're sitting in that cash position because you want to have that option value that you were talking about, that if prices do go down, you can then deploy that cash at much better valuations. All right, well, Mike, let me come to you next to talk about stops. These are, I think, probably the most common hedging technique beyond cash that's used out there, but I think for some of the viewers here, they probably never used stops before. Can you just briefly describe for folks how stops work?
Yeah, a stop is basically an order to sell generally or buy a security at a predetermined price. I'd like to say that having a stop means that you have a plan. Whether that stop is actually put in the market or if it's a stop that you have in your mind called a mental stop, it just means you have a plan. The easiest thing to do in the world is to buy an investment. That's easy. Press a button and you're in. How about getting out? That's not easy. Getting out involves emotions, and usually it means that you're going to have some regret. Either the stock goes higher after you sell it, or it goes down and you didn't sell it soon enough. So having a stop basically means you're stopping the trade, you're getting out. So it's a good thing to have, either a mental or a real stop. A stop is sometimes called a stop loss, but it doesn't necessarily have to imply a loss. You can have a different kind of stop, a trailing stop that protects gains. So in the simplest sense, a stop order is simply an order that you place with your broker that turns generally into a market order. Let's say a stock is trading at $100 a share. You buy it there and you decide, well, if it goes down to 90, I want out. The simplest example of a stop order would be that you put a good till canceled order in. It's a stop sell order in that case at 90. The stock touches 90, it turns into a market order if it's just a regular stop order. And you can feel good in general about getting out at 90 if the stock trades there in a normal fashion. Now, if the stock opens one morning down 50% at 50, it turns into a market order at 50. There's some nuances about other types of orders, stop, limit orders, and so on that we can get into. I'm not so sure that it's beneficial to talk about all those nuances here. The important thing to know is that with a stop order, you have a plan, and either you place that order in the market with a broker, like I just described at 90, or you even have a mental idea that, hey, if it gets to 90, I'm getting out. That's the important thing, is to have a plan. Most people don't have a plan.
All right, really well said, Mike. And yeah, we're going to stick at the relatively high level in describing each of these solutions here. Just not to make this video like a 5-hour long video and very complex. But the key point that folks should take away from this is there are lots of ways in which you can protect your wealth through hedging. But if you are inexperienced with them, we highly, highly recommend that you work with a financial professional that has a lot of experience with these, and they can be your guide in helping you determine which are best for you. I also love that you underscored, Mike, that one of the big things that stops do for us, in fact, most hedging practices do, is they remove the human element from the equation here. So we're humans, we're emotional. Very common, as soon as somebody starts taking a loss in a position, they go into the bargaining phase of, well, okay, I'll just hold it until it gets back to where I bought it, and then I'll sell out. And people can just exhibit a lot of self-destructive behavior from then on, as they'll oftentimes ride a bad investment down way further than they ever originally intended. And it's because their human programming gets in the way. Where to your point, if you just come up with an intellectual, empirical plan from the beginning of what your maximum loss potential is, stops are really helpful with that. And really quickly, I just want to, you talked about two types of stops. You talked about the traditional stop loss, which says, hey, if the price drops to X, I'm out. I don't want to take any more losses than that. You also mentioned the trailing stop order, and I just wanted to give a tiny bit more clarity on that. And that's where you basically say, I don't want to lose more than 10% of this stop. And so if the stock then rises, the nice thing about a trailing stock is, let's say your $100 stock goes to $200. Well, if you have a trailing stop on there at 10%, now that 10% drop would be, instead of 90, which is where you started, it's now 180. So you are, basically protecting your gains as the stock appreciates. So I don't want to get into any more detail than that, but I want to let folks know that there is some, interesting yet valuable variety of how stops can be used. Okay, now, John, let me come to you and let's talk about ETFs, specifically inverse ETFs and leveraged ETFs. And as we begin to get into some of these other forms of hedging, it's interesting. Some of these vehicles can also be used for speculation. They can be used to add risk to your positions, but we're going to mostly focus on how you can reduce risk in your positions with these. So can you define, John, what an inverse ETF is for folks?
Yeah, absolutely, Adam. So an inverse ETF is, well, first of all, an ETF is an exchange traded fund. That's an investment vehicle called an exchange traded fund. And they're like index funds, but they trade like stocks, okay? Now, an inverse ETF is one that tracks inversely to the underlying index that it's keyed to. Okay, so for example, we might talk about the S&P 500. There are a increasingly number of inverse ETFs keyed to the S&P 500 index that on a daily basis, now this is key point, all these products are meant to inversely track on a given day, and it resets every day essentially, the performance or the movement of that index on that day. Okay, now an inverse ETF on a given day, let's say the S&P 500 is up 0.5% on a given day, more or less. So there might be some small little leakage due to fees and things like that. But on that same day, an inverse, a one-time inverse, non-levered ETF keyed to the S&P 500 would tend to go down about 0.5% on that day. Vice versa also holds. If the S&P was down 0.5% on a given day, that inverse ETF should be up about 0.5% on that day. Now, the reason I want to emphasize the daily aspect that they track day to day is that feature is a feature and a bug in a sense. And depending on how the index tracks over time, up and down, there can be the introduction of what is called tracking error, where let's say over a 6-month period, the S&P 500 is down 3%, but the inverse ETF is flat or maybe up 0.5%. Now, most folks would be surprised that, hey, I would have thought this would be up 3% because the S&P is down 3% over that time frame. And it really depends on how that path has occurred day to day to get to that down 3% over a 6-month period because of the feature. And it almost bears a spreadsheet illustration as to how this can happen. But suffice it to say that the more volatile, the more up and down a path is, the greater the potential for this tracking error where the the performance of an inverse ETF is not exactly inverse in equal percentage magnitude over a span of time. Now, a leveraged ETF is one that, as the name implies, uses leverage to magnify the performance of that ETF. Now, case magnifying can work to or against you depending on whether the trend of the underlying index is in the direction that you expected it to be. So using you can get a 2 times levered ETF or 3 times, where again, using that example of on a given day the S&P going up 0.5% Well, a 2 times levered inverse ETF would be down roughly about 1% that day, and vice versa. If the index was down 0.5% on that given day, the 2 times levered inverse ETF should be up about 1%. And as with anything, when you get more magnification, that tracking error that we just spoke of can be all that much more magnified with a levered ETF. And, I talked about a 2 times levered. There are 3 times levered, which again magnifies for better or quite potentially worse the some of the dynamics we just talked about. We would generally advise folks to stay clear of the levered ETFs. Those are the hallmarks of speculation. Typically, a retail investor is not starving for cash in their account to buy a single non-levered ETF. When you start getting the levered ETFs, it starts to, generally speaking, veer into the category of speculation, not hedging. And we can certainly talk at length about that.
All right. I don't think we need to get it at length into it. I think you did a good job of describing it here. But basically, these are vehicles that go the opposite direction of some part of the market, whether you're buying an index or a sector fund or whatever. And so let's say perhaps you're long, you get a big long position in a certain sector, or you're just long the market in general, and you're worried that we might be going into a period of time where there's higher risk than normal of a market correction. Perhaps you might want to buy one of these inverse ETFs as short-term protection. And as you're saying, the longer you hold one of these inverse ETFs, the bigger the tracking error becomes as an issue. So it's really not something you want to hold on to for a long period of time. All right, so I think you did a good job of describing that, John. And for folks, I just want to emphasize for these, you're still long a vehicle. So you're buying the inverse S&P, whether it's 1, 2, or 3 times leverage, but you're long that instrument. I want to contrast that to now shorting, which is I think very common way of hedging, where you're basically it's similar in that you're sort of betting against where the price of a certain stock or index is going to go, but instead of buying an inverse, you're actually selling the security itself. So Mike, let me go to you. Can you quickly describe what shorting is for folks and how it can be used to hedge?
Yeah, absolutely. And we actually do use that strategy. I mean, right now we're short the S&P 500, and it's in a paired trade with our position in emerging markets. So, but shorting an instrument directly is a little bit different. Well, what we have done is we're using a non-leveraged inverse ETF, like John just described. But shorting directly can also be done. And the way you do that is you simply borrow a security and sell it before you buy it. It's really just the opposite of the normal investment or the trade that people are accustomed to, buying a stock, selling it later. If you short a stock or an index, you sell it first and buy it back later. So to do that, you have to establish an account with a broker. You have to have a margin agreement on file. Margin basically is a concept where you basically allows you to borrow from a broker, either securities or money, cash. In this example, you basically open up a brokerage account, establish the margin agreement, and borrow the stock and sell it first. You can pick any stock, but if it's an actively traded stock, it will be on the broker's borrow list. So if you wanted to short one of the big tech stocks, you would borrow it, sell it first. Let's use the same example of $100 a share, and then hopefully buy it back later at a lower price. That would result in a profit. So if you sold at $100 a share, then if you bought it back for less than $100 a share down the road, you'd make a profit. Important to keep in mind, though, that you have to post margin. So generally speaking, you have to post 50% margin to start a position. So if you shorted $100,000, just to use round numbers, you'd have to post at least $50,000 margin, keep that 50% margin. And if subsequently the value of your account decreases, in the case of a stock going up, you would have to post more margin. That's called a margin call. Generally, when the account falls below 30% equity, you're going to get a margin call. So there's some risk there, but the whole thing in concept is pretty simple in that it is just the reverse of what people are normally used to. So if you wanted to hedge a portfolio of tech stocks, you could short the QQQ or something similar, an ETF that tracks the NASDAQ. And, there's a lot of different ways to go about it, but that is the concept. You simply short a basket of stocks or an individual stock to hedge other positions, or you can simply do it in speculation because you think that it's going to go down. But you have to bear in mind the risks. And there's no limit to losses theoretically when you short, because a stock could technically go to infinity. Not in real life, but you can lose a lot more. If you buy a stock, you can't lose more than you put in. If you short a stock, you can lose multiples of what you started with.
All right, well said, Mike. So just to sort of summarize, when you're going long a stock or an instrument, your strategy there is to buy low and sell high. And when you're shorting, your goal is to sell high and then buy it back low.
That's right.
See you nodding here. Yeah. And it does offer some additional benefits beyond, say, an inverse ETF. One, it doesn't have the decay that the tracking error that John was talking about. And two, ETFs do have management fees and whatnot that do eat into the return. Shorting a stock doesn't have that. But it does have some material risks, as Mike mentioned, one of which is that your potential losses are unlimited. And we just saw, early this year with some of the meme stocks where a bunch of hedge funds got in trouble because they were short stocks like GameStop, which were kind of left for dead companies. But because something extraordinary happened, those stocks went from a couple dollars a share up to several $100s a share very quickly. And those hedge funds just learned how quickly those unlimited losses can rack up. So basically, the punchline there is just make sure you know what you're doing, and make sure that if you are shorting, that you have some stops in place and things like that, where you've got triggers that you're going to get out if it looks like your bet is going against you. All right, so John, let's now get into options, which becomes relatively easy to understand kind of in general theory, but they can become quite complicated quite quickly. I believe you guys are also working on another video that's going to delve more deeply into the details of the options trades that you guys use at New Harbor. But I know that you guys are very, very experienced using options as a hedging tool. Can you just sort of give the basics for folks here?
Yeah, I do want to make one point about shorting that to emphasize some of the risk categories. So because of the fact that shorting instruments requires a margin account, many folks lose sight of how that works. And in fact, margin accounts allow you to short more securities than what you have cash in accounts. So you can essentially become unwittingly levered in a margin account and really get into trouble. So folks should be very mindful that the margin accounts allow for a lot more buying power as the term is used than they have cash in the account, so to speak, or value in the account. But yeah, options. So I first want to speak to the fact that options there are certain uses of options that can be very, very speculative. And there's good reason why in many people's perception, options are very risky securities, because they can be used in those ways. We don't use options in that way. And in fact, with our client accounts, when we set them up for a very basic level of option permissions, such that if we accidentally entered a trade that would fall in the category of very risky, the trade would actually get rejected because our client accounts aren't. So for those that are inclined to use options on their own, we would encourage you to limit the kinds of approvals that you set your own account up for, to only include those that are quite conservative. hedging uses, not speculating uses. There are two types of options, okay? And the basic instruments are by name call options and put options. It perhaps makes sense to talk about put options because they are oftentimes the most intuitive kinds of options for folks to understand. And that's because put options, if used on their own as a hedge, it takes some of the label of what's called a protective put option. And it's very analogous to insurance. So let's say you own $100,000 of a given stock, or even 10,000, whatever the number is. Let's say you have 100 shares of a stock, and you want to draw a line in the sand that you don't want to suffer more than a 10% loss, okay? And you want to essentially buy insurance 10% down from here. Well, that would be a perfect analogy for using put options. Let's say the stock is at $100 a share, and you want to buy protection below $90 a share. You would buy a put option that has a so-called strike price of $90 a share, and you have to pay something for that option, okay? The so-called insurance premium, but you would be protected below, if the stock were to drop anywhere below $90 a share. Even if it went to zero, you would be protected by that option for that difference, 90 to zero. Now, like insurance, there are a couple of parameters that make sense to talk about. Most forms of insurance involve a premium and a deductible, okay? And generally speaking, or the law of insurance is the bigger the deductible that the insured party is willing to bear themselves, the lower the premium that they have to pay. Okay, so it's a trade-off between paying premium and assuming deductible. In the case of that analogy I just gave of the $100 stock and you wanting to protect 90 or lower or below 90, that $10 difference, the 100 to 90, that is effectively the deductible that the hedger would have to bear before the insurance kicks in. And it might cost, let's say hypothetically, $1 a share for that protection, that put option, okay? So that $10 deductible plus the dollar outlay for the premium would effectively be an $11 downside risk or maximum downside to that party. Because again, the deductible plus the out-of-pocket premium. And then anything below that would be losses offset by the put option, okay? Another key feature of options is that they have an expiration date. An option, they trade every month and even on weekly horizons for shorter term options. But, depending on how long in the future you want to secure that insurance for, you would pick that expiration date. And again, another law of the universe, I suppose, is the longer you go out in time, the more expensive that insurance is going to be. Okay. So I'll just pause there. That's the put option. Call option is a flip side of that, where there's no cost for, whereas you buy a put option, we use call options, and a great way to use them in hedging, it's a partial hedge, however, is to do what's called a covered call option, where you own an underlying stock and you want to mitigate to some degree the downside potential in that stock. And you can do so by selling a call option against that stock. Again, you need to own the stock to be able to sell that call option and have it be a hedge. If you don't own the stock and you sell the call option, it's referred to as naked call selling, and it's actually an unlimited and very risky proposition to do. But again, you sell a call option. In this case, you get paid a premium by the buyer of that option, and that premium serves to offset to the amount of that premium downside potential in that stock. So it's an imperfect hedge. It only limits your downside or offsets your downside to the degree of the premium that you collect. So covered call writing is a bullish strategy in its form, but it does offer some downside protection. Now, to make things tie a bow on those two options, they can be combined together in ways to create a very robust hedge and essentially pay for that hedge using money not out of your own pocket. So this is what we refer to as a collar, where you sell a call option and use the premium that you collect by selling that call option to pay for the put option, essentially making it what is referred to as a costless collar. Now, again, to make the point that there is no free lunch, there is a cost to a costless collar, and the cost is the opportunity cost of foregoing gains or upside beyond the strike price of the call option. Okay, so both in covered call options and collars, where you sell a call option, you're willingly giving up upside beyond that strike price on the call option. Okay, so I'll pause there.
All right, and I think you did a good job. I mean, it can be a complicated process for people to understand if they don't have any experience with it, but it really isn't all that complicated once you've done it once or twice. But essentially, John, what you're saying is, or let me say this: I think a lot of the types of strategies that you're talking about and that you guys use at New Harbor, not only are they defensive, but they're helpful for people in general who have a sizable position that they want to protect. So they might have company stock that they don't want to sell or can't sell. They might have had stock that they've been gifted that they don't necessarily want to sell or whatever, or they just believe in the long-term prospects of that position, but they want to protect it in the near term. And so what you're doing is you're using the strategies that John mentioned here, either to spend a little bit of money to protect against a big downside, right? Of maybe you give up a couple $1,000s, but you're protecting against many tens of thousands of dollars of potential downside. Or, as John's talking about, there are ways in which you can fund that downside protection, not by having to take money out of your account and pay for it, but just by giving up some of the opportunity cost should that position not go down in the short term, but actually go up in the short term. Above a certain amount, you won't participate in that gain, but it's because you traded that for the downside protection. And depending upon people's specific needs and specific risk tolerance, one might be vastly favorable to the other. So, all right, I think you did a good job there. Again, options, there's an awful lot that could be done there. John talked about the basics of puts and calls, but even got into collars and covered collars and things like that. There is a whole lexicon of other different techniques that you can use with options. John and Mike at New Harbor are putting together a more detailed video about how they use options very successfully to mitigate risk beyond what we've just talked about here. And if you're interested in that, at the end of the video, I'll tell you how you can get on the mailing list with these guys to get alerted when that video is out. All right, Mike, I'm coming back to you now for the last topic on our list here, which is futures. And I'm pretty sure that most people here have probably heard the term futures, but I'm pretty confident that most people here have never traded one. Can you just demystify for us what futures are?
Yeah, futures really were created to help farmers. I think originally farmers wanted the ability to trade they wanted to sell their crops and to lock in a price. They might want to sell in March a crop that is going to be harvested in October. And there was wild swings in their income because of the price of different things, corn and wheat and soybeans in the future. So futures contracts basically said, I want to sell, 5,000 bushels of corn in November, and I want to do it in April. And so that's a simple futures contract. And the Chicago Mercantile Exchange kind of grew up around that time and is a facilitator or a brokerage for those contracts. There's other futures exchanges now, but still the Chicago Mercantile is the biggest one. So it originated with agricultural type things, then went into other things like currencies and other commodities like energy. And lastly, into different indexes like financial instruments, like equity indexes, bond market, et cetera. So you can trade anything, almost anything in the futures market. And there's some key differences between futures and other types of instruments. For instance, if you want to short the S&P in a brokerage account, I mentioned earlier that you need a margin account and you need to borrow that instrument and then go ahead and sell it first. In the futures market, there's really no such requirement to have to borrow a security and then sell it. The futures exchanges simply can create a negative position or a positive position out of thin air. So you don't have to borrow it. So you don't have the issue with hard to borrow securities. Secondly, the leverage is greater. You can get greater leverage in a futures account. You may have to only post 5 or 10 or 15% of the value of the security to enter a long or a short position. There's other advantages too, like for instance, if you're short a stock, you have to pay the dividend. If you're short, it means you borrowed the stock from a broker and that stock pays a dividend, you owe the dividend as a short seller. That's not the case in the futures market. So it's cleaner in that sense. And I guess lastly, the futures market is probably a better way to hedge some things like gold and silver. It's easier to create a negative futures contract or a short futures contract on those things. It's a little bit cleaner and easier, particularly on large positions, than it would be to do so with options or other means. So I really think it's probably beyond the scope of what most people will end up doing, but it's important to know that, for instance, if you're going to move to somewhere in South America, for instance, let's say you're going to move, I don't know, I happen to notice, I was talking to a gentleman recently about the Colombian peso, because he is going to maybe move there someday. There is a futures contract on the cross between the US dollar and the Colombian peso, or the US dollar and the Japanese yen. If you think that you're going to move, let's say, to Japan a couple of years from now, and you've got a significant net worth, you want to start converting to yen, you could buy a Japanese yen futures contract due a year from now, essentially lock in your price. So that's another example of a hedge. So it's a pretty clean market to be able to do that in. And beyond that, I'd be happy to say that we could talk to people about other nuances, but it is something that you want to be careful with and not get involved unless you're pretty astute or working with a professional.
Got it. Yeah. And as I understand futures, and I'm not an active trader of them, they differ from options in the sense that the option gives you the option to transact at the end of the agreement, your choice, basically, where the futures contract is an agreement that once that futures contract expires, that transaction is going to be consummated, either in delivery of the underlying commodity itself or in cash. Is that correct?
Yeah, that's absolutely true, Adam. Most of the time, though, you simply close the contract before the delivery date. There's what's called a notice date, where you get the warning. Then there's a delivery date where you actually have to make good on either accepting delivery of that underlying or delivering the underlying. Normally, you would simply close out that contract and roll to a future month. It's called a roll. And you can either have a negative roll yield or a positive roll yield, depending upon how the different months are priced.
All right, great. All right, guys. Well, with that, let's bring this to a close. I think that's enough information to pack into folks' minds in this single video here. Folks, though, as I mentioned, everything that we talked about here and some more detail are included in the free report that goes along with this video. You can download that for free at wealthion.com/hedge. And I hope, if nothing else, that this video showed you that there's lots of opportunity out there to protect your wealth against future volatility in the markets. But it really does require some experience in each of these different practices that we mentioned. And as we kind of went through the spectrum, the experience needed becomes greater and greater. So for folks that don't have any initial experience in these techniques, but would like to investigate deploying them in their portfolios, their own portfolios, highly recommend that you work under the guidance of a professional financial advisor who can hold your hand through all this, work with you for your goals, your personal risk tolerance and all that stuff, and design a custom strategy that makes the most sense for you. If you've already got a great financial advisor who can do that, awesome, stick with them. If you don't, consider talking to the guys at New Harbor. They give free consultations to folks. They do it as a public service. There's no obligation to work with them. There's no strings attached. If you want to chat with them, just go fill out the form at wealthion.com. Only takes you a couple of seconds. And as I mentioned earlier, if you fill out that form and have your chat with these guys, they will then reach out to you when their more detailed video on options becomes available. And that's the best way to learn how to get alerted to that. And again, if you want the details on more about how to connect with the guys at New Harbor, we're going to give you that at the very end of this video. It's coming up in a second, so just stick around for that. One important thing I want to hammer home about hedging is that it only works if done in advance. Once the market moves, you can't turn back time and say, whoa, no, I wanted to buy my insurance then, right? You can't buy your fire insurance after your house just burned down, right? Guys, I got a couple quick closing remarks, but just anything you want to add to that important point, John?
Yeah, that absolutely. You can't buy insurance after your house is burned down, obviously. So it's a proactive thing. By definition, time is working against you when considering hedging, because that proverbial house burning down could happen at any given point in time, and you don't want to be too late. I need to make one other very clear point. Adam talked about working with an advisor. Couldn't agree more. These are hands-on things that most folks don't either have the interest or experience to work with. I do need to point out, though, that we here at New Harbor can deal with all the tools we just talked about, with the exception of futures. While we're quite familiar and understand the futures markets, we are not, for regulatory reasons, licensed to provide futures trading support for clients. So I just want to make that very clear. But that's about all I have, Dad.
All right, great. Well, folks, look, if you've enjoyed this video and you'd like to see more explainer videos on key concepts like this in investing, do us a favor and hit the like button, and then subscribe to this channel if you haven't done so already by clicking the red subscribe button below, as well as that little bell icon right next to it. Believe it or not, those two simple steps really do help us get these videos better distributed out there into the world through YouTube and the other platforms. All right, as I mentioned, don't forget to download the free report at wealthion.com/hedge. John and Mike, thank you guys for sharing your expertise, and everybody else, thanks for watching.
Thank you, Adam.
Thank you, Adam. Appreciate the time, and hope folks found this helpful.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to Wealthion.com. These consultations are completely free, and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the Wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to Wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.